we have just talked about the trade discount and the cash discount. Now let's look at sales return. So before we begin to talk about sales return, do you remember what journal entries we make when there's a credit sales? So when there's a credit sales, what journal entry do we make? We debit account receivable, credit sales revenue, and we debit cost of goods sold, credit inventory. So this is the journal entry we make when we make a sale. But a lot of the time when we make this sale, we may also give our customer an option to return those goods in the future. So what do we need to do now? There's actually a number of different events we need to take care of under this situation. So first of all, before my financial reporting period end date, the customer may already return something to me. So before I close my book and making adjusting entries, the customer may already return those goods to me. So, and then under this situation, the journal entry I need to make is to debit sales return, which is a contra account to sales revenue. Credit account receivable, debit inventory, credit cost of goods sold. So this is just like reversing the sales journal entry I made. The only difference is instead of debit sales revenue, I debit sales return, which is a contra account to sales revenue. So this is the first thing that may happen after I made the sale. And then if in some other situations, so I may give my customer a very long term to return their goods. And but I need to close my book every period. So every period end, I need to make some adjusting entries to accrue for the possible sales return. So those possible future returns, those are associated with the sales I made in the current reporting period. So that's why I need to accrue for any possible return in the current period as well. And the journal entry I make is to debit sales return, credit allowance for sales return, debit inventory estimated return, credit cost of goods sold. So what is the difference here? As you can see, compared with the previous journal entry, in this situation, those returns hasn't been made yet, but I estimate those other returns that may be made in the future. So here, instead of credit account receivable, I credit allowance for sales return, which is a contra account to account receivable. So it is a allowance account. It is my estimation of how much account receivable may not be received in the future because of this possible future sales return. And instead of debit inventory, I debit inventory estimated return. So this is because those inventory hasn't been really returned to my warehouse yet. So, but those are the estimated inventory that may be returned to my warehouse in the future. So instead of debit inventory, I debit inventory estimated return. And then in the following period, so if the previously accrued return actually occur, what I do is I debit allowance for sales return and credit account receivable. I debit inventory and credit inventory estimate return. So this journal entry, is there any income statement effect? No, there's no income statement effect. So it may impact different accounts, but there's no real income statement effect. And is there any real balance sheet effect? Is there any net balance sheet effect? No, there's no net balance sheet effect. So in other words, when we make this, when this happen, when those return really happen in the next period, it doesn't really impact my net income. None of those accounts is an income statement account. And it doesn't, even though it affects different accounts on my balance sheet, but there's no, it doesn't really affect my net account receivable because those are account receivable and it's contra account. So my net account receivable doesn't really change. It doesn't really affect my net inventory. So there's no net balance sheet effect either. So now let's look at an example. If I sold 2 million of cupcake during 2015, the net cost of cupcake is 60% of sales price. It is estimated 10% of all sales will be returned, and the customer returned 130,000 of sales during 2015. What is the journal entry at the end of 2015 to record estimated return? Assuming sales return occur in 2016 as expected, what is the journal entry when return actually occur? Please take 5 minutes, try to work on this example, and you can pause your video for now. So first of all, at the end of 2015, I need to accrue for the sales return, and my journal entry is to debit sales return, which is a contra account to sales revenue, and credit allowance for sales return. So for what amount? My original sale is 2 million. And it is estimated 10% of those sales will be returned. And during the year 2015, already 130,000 is returned. So what is the rest that is expected to be returned? So the rest is 70,000. And then I debit inventory. Estimated return. Credit cost of goods sold. What is the amount? This 70,000. So the cost of the cupcake has 60% of the sales price. So multiply by 60%, that gives me 42,000. So 42,000 cost of goods sold. And how about in 2016, when those returns actually occur? My journal entry is to debit. So now I can reverse this allowance account. I debit allowance for sales return for 70,000. And now I can credit my account receivable for 70,000. So those accounts are no longer receivables because those goods has been returned. So I no longer have the right to receive those account receivable from my customer. And then I debit inventory, 42,000. Credit inventory, estimated returns, 42,000. So now they are no longer my estimated return. They are already returned, so they're back to my warehouse. They go back to my inventory, 42,000. So this is how to account for sales return.